Hi there, Brian again from financenerd.net. So this is a follow-up from our first of two videos on how to calculate alpha and beta, or risk-adjusted return, for an investment portfolio. So we went through and we looked at what the S&P 500 did over a period of time versus how we did over a period of time. We calculated the return for those levels. And then we generated some statistics about the absolute return, the standard deviation, etc. And we learned that the alpha, or the risk-adjusted return, was actually negative. Even though our absolute return was higher than the market, the added volatility made it a less desirable investment than the S&P 500. So no good, right? We need to find an investment or adjust our strategy in a way that produces less volatility in order for it to be a desirable strategy. So now what I'm going to do is I'm going to scroll down and show you a second scenario of returns. And again, these are just randomly generated values to illustrate this point. So what I've done here is I've randomly generated some returns, and versus the S&P 500 numbers are real for the last 24 months. But I went through, and this is just the natural log of the difference between the 2 months, the most recent months. So it gives us the return. Then I'm going to go ahead and just copy and paste these statistics that we generated, calculated in the first video, and I'm going to just paste them down here and save a little bit of work. So we see that the absolute return for this period of time for the S&P was 44%, but for our strategy was only 27%. So on the surface it looks pretty bad, right? But if you look at the volatility, we had a lot less volatility than the market. And this is unusual to have such low volatility, but it's not impossible. Our average return per month was much lower, but when you look at the coefficient of variation, having less than 1 unit of risk per unit of return is pretty good. And then we calculated the alpha, which is positive, and we calculated the beta, and we did that using two different methods. This using the Excel function intercept and the Excel function slope, and then over here we used it matrix algebra, kind of the long academic way of doing it. So then we can look at a scatter chart, insert scatter just with dots, and then if you remember, I like to go in and into this trend line menu down here to more options and tell it to display the equation on the chart. And it always puts it right in the middle, but let's drag it over and show you here that these numbers are the same as these numbers. So we have an alpha of 0.75% and we have a slope of 0.16, or a beta. So the difference between these two charts is interesting. These two scatter charts, we'll look at them together here. On the more volatile returns that we were looking at in the first video, our intercept of the y-axis is negative. It's below the x-axis. But in this case, the intercept is positive, meaning we have a positive alpha, or that we had better risk-adjusted returns for this strategy than the market had to offer. So which of the two strategies would you rather invest in? Would you rather have 27% with less volatility, or would you rather have 46% with significantly more volatility? And that's kind of the age-old question with regard to investing. Personally, I would prefer the lower beta. I would prefer the less volatile strategy. So that's kind of the process you should go through when you're looking at portfolio investment performance. And go through this process. It's very simple. It only took a few minutes. You can do this in 10 minutes. You'll have to go through and look at your monthly statements to generate or to record your account value at the end of every month. But that's something you should be doing anyway. So thanks for watching the video. If you have any questions or comments, please leave them below, and I'll do my best to follow up. Thanks a lot.